Hey, what's up? This is Brendan Ives. Wanted to share with you a quick thought on credit scores and how they affect your financial future, how they affect you trying to pursue winning with money. So, if you were to look at the PowerPoint that I've got up here, I want to explain a couple things about credit scores and how they're determined and who makes these decisions. So there are three reporting credit bureaus: Experian, TransUnion, and Equifax. And all three of these groups will take information and they score it to give you a score somewhere between 300 and 850. So if you were to take the different aspects of your credit, the score is based off of your payment history, the amounts that you owe for credit. So let's say the amount you owe on a debit card or a car that you have borrowed money to buy. They also take into account your credit history. So how long have you had credit with these different providers? So the length of the time you have had a credit card open will be to your benefit long term, as long as it's paid on time. And then you have credit mix. So they don't want to see a really high credit card limit and a low sort of credit that is not tied to tangible assets. So they're going to treat a home differently. They're going to treat a personal loan or a credit card. So you having a mix of different types of credit. So credit on a house, credit on a car that's attached to a vehicle's value are going to be treated than of credit that you might have built up at JCPenney's or Sears, or I know these are a bunch of companies that are out of business now, Lowe's or Home Depot, and then with Capital One for say. So they're going to treat those credit mix in different ways. And if you have it leaning too far towards, say, credit cards and not enough towards hard tangible assets, they're going to rate you down on that. And then new credit. So the new credit inquiries that you think about when it comes to taking out loans, this is how it's sort of broken down. Now, there's a percentage. So if you'll look at this quick chart, you'll see that the length of credit history is 15%. New credit or recently opened accounts is 10%. And then types of credit in use is 10%. So that credit mix, that new credit, and that length of credit history only accounts for 35%. The much larger things that you can control is the amount owed and then your payment history. Your payment history is the biggest factor. So if you consistently make payments that are reported to Experian or other credit bureaus, then that's going to have a bigger impact than if you don't have, long-term credit history. So then, let's just say you're 25 years old, you're out of college, and you've taken out your first credit card. You're going to see that is going to affect your of credit, but not in the way that payment history will or the amount owed will. So your behavior, your actions are always going to be more important when it comes to credit. Now, how does this really affect you? Well, the Wall Street Journal recently put out an article and it broke down the average mortgage interest rates by credit score. So you can see that if you have a really high credit score, we're talking 760 and above, then you will have a average of 6.06% on a home loan. If you are down in the 630s, let's say 620, 630, you're going to be seeing an average of 7.65%. Now that doesn't look like a huge difference. We're only talking about a point and a half, 1.5% difference in the rate. But when you actually look at how much it costs you money wise, if you have a good credit score, that's 6.06, you're going to be looking at a $400,000 loan with 10%, or actually 3% in this illustration, 3% down. The cost of that mortgage is going to be $2,670 per month. If I was to take that and put that 765% credit score, all of a sudden your payment's going up $500 a month. So you're looking at, $3,081. That's a pretty substantial difference each month. And remember that, this is the home, this is property taxes, this is principal and interest. The interest part is the largest area where this makes a difference over time. So if we were to take these two loans and just look at the difference, the 620 credit score is paying $3,081 per month, but total interest paid on that loan over 30 years is $603,000 versus the total interest from that person with better credit. They're only paying interest of $455,000. So that good credit score over the course of 30 years of home ownership is saving that individual $148,000 in real dollars that they're getting. Is this a huge difference? So yes and no. So yes, you can see there's a lot of money there. I mean, that's over the average. That's probably 2 times the average of income in America right now. So I mean, that's a large amount. You're putting 2 extra years, maybe 3 extra years of your salary into interest payments that you're paying to a bank. If you have a low credit score and you buy a home, if you have a good credit score, you're saving, potentially 3 years of income to pay off that house. The other thing is you can use that money. So there's opportunity loss there. So if you were to take that, extra $300, $400, $500 that you pay in extra interest every month, and you were to take that money and put it in, let's say, a retirement account, over 30 years, there's going to be hundreds of thousands of dollars difference there, not only in money that you didn't pay the bank, but then you could invest yourself and grow over time. So the difference is huge when it comes to the difference between having a good credit score and buying a house, or purchasing anything and having a low credit score. So how do you fix this? Well, that is pretty easy. We saw the chart a few minutes ago. Basically, if you can consistently make your payments on time, you can have a good mix of credit, and that credit in use is you're not maxing out those cards. You're paying off things regularly. You're keeping the access to credit high, and you're keeping the amount of credit use low. If you can just make your payments on time, pay off things like credit cards, pay down debt like car debt or personal loans, and then that over really it can take 6 months to a year of just making payments on things, paying off credit cards, making payments on time. You can see a big shift in your credit over 6 to 12 months, and you'll see a lot of savings when it comes to your interest rates on your home, the interest rates that are available on a car purchase or anything like that. Your credit score will matter a lot. So I hope that gives you an idea of what credit scores are, how they affect you in reality, and how you can try to, control your behavior, control your actions in order to get more out of the money and the investments that you make in something like purchasing a home. Hope you have a great day and look forward to speaking with you the next time we talk. Take care.